Hello, welcome. Thank you for tuning in, listening in, watching. This is Cincinnati's best ever real estate mastermind COVID edition Zoom webinar. We're live with a boatload of attendees, and some of you will be watching this on YouTube afterwards, or maybe in Facebook. We have an awesome guest. I'm really excited. He's my CPA. As some of you may know, that I teased this video in our Facebook group yesterday, this webinar. I'm really excited to talk about Phil. Couple of ground rules before we get started. We use the Q&A feature on the Zoom. You should see it there should be a Q&A logo towards the bottom of your screen, whether you're on a mobile device or a computer. Q&A, if you ask a question there, I will track it, get you a response. I may ask immediately, I may add it to my notes, hold it for the end of the webinar based on the conversation that we pseudo planned already and whether or not I think it'll come up later. Feel free as well to use the comments section. I'm the one who's tracking all of that. Phil may not be looking at the chat. He's probably not looking at the Q&A. And yeah, let's go ahead and get into this. So Phil Weickert, people know that you're my CPA. You're also a real estate investor. Tell us a little bit about yourself. Tell us your story.
Yeah, so Phil Weikert, I own my own tax practice, Strategic Tax Services. Been a CPA tax preparer my entire career. Started out at Deloitte and then eventually started investing in real estate. And that's what drove me to working with individuals and businesses. I just got real excited to help solve what was potentially difficult situations for clients. And so from, during my transition from the big four to my own, I was investing in real estate, started with single families and made my way up all the way to 29 units, about 10 buildings. And there's about 5 buildings with a 50-50 partnership, and then 5 buildings of my own, and done it from anywhere from the MLS, off market, seller finance. I've done a couple of wholesales in between. And so the CPA business is primarily working with real estate investors. I'd say 80% of my clients have real estate investment of some sort. Most of those investors are probably in the buy and hold area, with a handful in either flipping or wholesaling. And those clients look from anywhere from ones that are just getting started all the way up to have in the thousands. And so love working with real estate investors. I like to say I'm slightly different than most CPAs just because I care about the tax return, but I really care about the relationship and the planning and the education when it comes to taxes and real estate.
That's awesome. There were some buzzwords in there. They were not things that we were planning to discuss, but I do want to point those buzzwords out. If any of you watching now have questions about them, he talked about wholesaling. He talked about scaling up from single families. He also said he's finding deals off market and he's doing some seller financing. So if you have questions, I have a little bit of experience with those things too. If you have any questions about that, we'd be more than happy to get those answered. You said your current portfolio, you're at 29 units now. When did you start as a tax preparer, and when did you start investing? What did that look like? Why did you decide real estate investing?
So I started my tax career in 2012, and I was working on businesses, Fortune 500 companies, and also some of the wealthier individuals. And one thing I started noticing was what they were investing in, and primarily everyone had real estate. That could be from commercial all the way to residential. And then from there, I got hooked on Bigger Pockets. Would listen to every podcast during tax season, and just really started getting the itch. My first rental that I had was actually, I lived in it and then rented out every room to friends, just because what I was paying in rent, I thought I could get cheaper buying a house in 2013. So that was the first year I bought a house. and rented out every room and didn't even have to worry about any mortgage. And so a month later, I bought my first official rental. It was another single family. It was about 2 doors down, and then just continued to grow from there.
Awesome. And when did your single family, I'm going to call it a house hack for those of us on here who are Bigger Pockets fans. When did you get the house hack? When did you start doing that?
So I did a single family house hack in 2013. And eventually, once I got engaged and my fiance at the time moved in, that's when I kind of stopped doing the house hack. But actually, 2 years later, I bought a duplex and lived in the duplex and house hacked that.
Gotcha. Yeah. Pretty similar paths, all things considered. I bought my first house hack in 14, but it was already the multifamily. I was already married. We also
And
both have young kids now. Sorry, go ahead.
and I was going to add to the house hack. So I ended up selling the single family that I lived in, and so what I did is after I moved out, I turned it into a rental. A lot of people will hear of the tax-free personal house sale, and so the goal is you have to live in it 2 out of the last 5 years. And so I rented it for about 2.5 years and sold it. I did have to pay a little bit of capital gain on the depreciation I took, but pretty much I think when I calculated that over a 6 year period, made about 600% off of that one and didn't have to pay very much tax.
That's not bad. 600%, 6 years. That's good stuff. Is that 100% return annualized or
It I didn't look at the annualized, but it was about 600 over the 6 year period.
gotcha? Cool. We have a question from Nathan. I'm going to go ahead and ask. It sounds like you used partnerships to scale your portfolio and your investing. First of all, is that the case? You started by yourself and now you buy things with partners, and that's how you scale. Is that what's happening? And do you have any recommendations for scaling with partners?
I would say I definitely scaled a lot quicker with partners. I would say, and I would change the verbiage to using other people's money because cash is king in real estate. And so, so in 2013 when I started, 2016 is when I met my partner. We bought 6 properties in about 3 or 4 months, wholesaled one, and then we held on for one for a year and sold it. But to this date, the three single families that we started with in 2016 that we kept, we were able to cash out refinance those 3 times, which allowed us to buy 2 4 families and still give us about $20,000 back in cash. And so I definitely agree that using other people's money and partnerships is a great way to do it. I think if you're going to do partnerships, for structures wise, I think the most important piece is understanding who's going to do what up front. Because I call it the honeymoon phase. It's very easy to get stuck in that and you're making money. But, after the time settles down, who's supposed to be doing what, who's getting paid for what, things like that. And that could be if you're having 2 active partners, if you're having an inactive partner or a passive investor, that changes things, and just making sure that, they're getting their distributions. In regards to structures, so I'm not an attorney, but my personal opinion is the LLCs are the most flexible and they provide a lot of benefit both on the tax and the legal side.
Couple of things I'd like to point out and add to that, Nathan. Make sure you understand what role you would play in a partnership. Another way to look at that, and this is for everyone, is understand the value that you can bring to a partnership and how that value can be multiplied by partnering with other people who have other strengths or other resources. For example, one of the things that I'm doing in real estate right now, I am good at deal finding, negotiating, and also property management, but my capital is limited. So I'm finding ways to bring on capital partners who allow, I still invest in my own deals, but I can get a much better return on my investment if I'm also bringing a whole lot of other things to the table. So that's a good thing to keep in mind. We also have a question from Jacob. How difficult are taxes for house hacking individuals? Have you run into problems keeping everything separate, i.e. personal versus business?
So the it can be. I mean, and most any CPA that's good should, most answers is it depends or it can be. So the key with that is you know, how I recommend to clients is, even if you're living in the building, keep a separate bank account for that property. All income comes in and all expenses go out. Now, some of those expenses are going to be, potentially personal. So like the mortgage interest, the real estate taxes, the insurance, those are all going to be split. The easiest way to do it is to figure out the square footage of the rental units and figure out the square footage of the personal, and then you just do a proration off of that. Now, when it comes to, like, if you're doing stuff to your unit, you really can't deduct it until you get until it either turns into a rental or you sell it. So keeping track of those on the side is crucial. And so really thinking, okay, what's the intentions? I would always say, what are your intentions for when you spend that? Is it for the whole property? Is it for that rental, or is it for your unit? And if you can answer those questions as you spend, then it'll help break that down easier.
Something I'd like to add, because I'm not a tax professional: consult a tax professional. Phil doesn't have to say that because he is one, or maybe he should say that. I'll tell you, I did my own taxes until I messed them up and got audited, and now Phil does my taxes. He also helps me through that audit, and we can talk about audits later. I want to dive into more specifically talking about the value of real estate investing when it comes to tax planning and some of the peripheral benefits. You know, Phil said cash is king. For a lot of people, cash flow is king. And you hear a lot about, especially if you're listening to the Bigger Pockets podcast right now, you hear comparisons between markets, where some markets have appreciation, and you buy there and you don't need a whole lot of cash flow because you know the value is going to increase. And then there are areas where you buy for cash flow, where your cash on cash return, your return on investment is going to be high, even though the property is not going to appreciate in value as much. One of the things that gets missed often in that conversation is the tax advantages to real estate investing, which is something Phil can definitely speak to. I'd like to jumpstart this conversation, though, with this isn't necessarily a quote, but Tom Wheelwright talks about it in his book, Tax Free Wealth. In fact, I think it's basically the introduction to that book. He says that the US tax code was designed to do two things. Only one of those really gets talked about. The one that gets talked about is that the tax code is designed to fund the government. It is also designed to incentivize economic activities that are to the benefit of the nation. That's a loaded way to say that. We live in a very politically charged time. I'm not trying to get political. I'm saying that the people who created the tax code created it to do two things: fund the government and incentivize economic activities that are for the betterment of the nation. Warren Buffett, very famously, and maybe every year when he does his taxes, talks about his effective tax rate being lower than his secretary's. That's because, so far as the economy is concerned, his secretary is an end user. She receives a W-2 salary. She spends money, and that's great, but she's not doing any of the economic activities that are incentivized by the tax code. And Warren Buffett is doing boatloads of them. Lots of wealth is created and opportunity is created because of what he's doing. And the people who created the tax code will say that that is why his effective tax rate is lower. Um, Phil, you and I talked about this a little bit when we were getting ready for this. for this webinar, and you had some things you wanted to say about that.
Yeah, and I think that a good way to segue, and it's part of the whole Rich Dad Poor Dad, is the quadrants, the cash flow quadrants. And you got the employee, the self-employed, the business owner, investor. And the reason I think those are important to understand, the quote that comes from Tom Wheelwright and also Warren Buffett is, the employee, unfortunately, is going to potentially pay the highest tax. And it's because they had the least amount ability to deduct items. And that could be, thinking, which goes into the self-employed is, you might earn the same amount, but now we get deductions. On top of that, we also need to think about how many different tax levels there are. In Warren Buffett, he's talking about effective rate being the income tax. Well, through the other three cash flow quadrants, the self-employed, business owner, investor, there's different types of taxes we get to pay. And so the investor, which is what Warren Buffett's made most of his money from, is usually going to have your lowest taxes. We hear a lot about the long-term capital gain tax rates, which are a 0, 15, or 20% tax rates. And so the investor could have the best advantage. Plus, they're passive. The passive, you don't have to pay the self-employment, which is going to be your Social Security and Medicare taxes. And so the self-employed, you're going to pay your income and your Social Security and Medicare. So what I'm trying to get at is, as I kept talking long, my tax nerd is coming out, is there's multiple different levels of taxes. And so the incentivized to keep the economy going is, as a business owner or self-employed or investor, someone's putting money back into the economy. I'm hiring a contractor. I'm going to Home Depot. I'm doing all this. So me spending money, I'm lowering my taxes, but that other person is going to have higher revenues, which means they're going to pay taxes. But on the flip side, we're going to have sales tax. You're going to have Social Security and Medicare tax. And then if we think about it from the real estate side, the investor, you're paying property taxes. And when we buy properties that are above the market values or the county values, now all of a sudden our real estate taxes go up, which is another way to fund. So there's multiple different levels. By us spending money to lower our taxes, someone else is claiming it, or there's producing another type of tax that is help funding the government.
Investors create, through the use of their funds, a lot of other taxable events, and they're also infusing more money into the economy. And that's one of the things that's incentivized. That makes a lot of sense. Phil, I announced in our Facebook group yesterday that you helped me save on my 2019 taxes $28,500 off of one property. And that's $28,500 that I didn't pay to the IRS because of one property that I, in fact, bought in 2019. How did you do that?
Magic. But no, it's one of those that, so I think to start off, when you buy a property, you're buying a building and land, but you're also buying other assets that are in there, but you're buying it in a one lump sum number. And so, how we did it for Slocomb is we did a cost segregation. Cost segregation, in simplest terms, is splitting out that one purchase price into multiple different levels of items. And the reason that's benefiting Slocomb in this situation is if he just bought the property and we didn't do the cost segregation, then he would depreciate that property over 27 and a half years. But by us breaking it out, he had, I think there was 20 some units. And so he probably had, 40 or 50 appliances. And so, whatever he purchased it for, we broke out the appliances, and then we broke out the cabinets, and we broke out the countertops, and we broke out the blinds, et cetera, et cetera. And by breaking it all out, they fall into different tangible property categories, which with the IRS determines and defines lives for those. And so the lifes are crucial because that's how we can do bonus depreciation, or we can speed it up just because it's instead of 27 and a half years, it becomes a 5 or 15 year. So by us doing the cost seg, we pretty much took the lump sum that he purchased it for, broke out what was a 5-year, a 15-year, and took 100% bonus depreciation on that, and then was able to depreciate it all in the first year. And so because Slocomb is a real estate professional, we were able to take 100% of that on his tax return and reduce all of his other income to take it to a zero. And so through this, we actually also created a net operating loss, which now he gets to carry forward to 2020, which then can reduce any of the activities he has in 2020.
So my wife supports my real estate investing habit, but is not actively involved. And when she figured out what our 2019 taxes were going to look like and what this cost segregation and real estate investing were doing to the taxes that we owed for 2019, and the NOL, I think you called it, net operating loss, that we were going to be able to carry into 2020, my wife said, "Oh, that's why Donald Trump only paid $750 in income taxes." And I'm not trying to get political, but it was a fun moment for me to see that light bulb go off. For my wife, I was like, "Oh, that's how he did that." Yes, that's basically exactly how he did that. He's been stacking losses on losses on losses for years. And again, I'm not trying to make a subjective opinion about Trump. Objectively, I'm just talking about how his taxes have worked, not trying to give an opinion about it. Phil?
But I think real quick, not to go to the political, but with the cost seg. So in Slocomb's example, we talked one property, a real large property. The fees on a cost seg real large, can range anywhere from 2,000 to 5,000. But it doesn't mean you can't do it on a single family. You can't do it on a 4-family. Luckily Slocomb, with the amount of savings we got, the fees actually paid for it. And so the benefit, like I had a client this past year, had two 4-families, and he's owned for 4 or 5 years, and he's done so well with them that he's cash flowing really heavy now, and had a large taxable income or tax because of those. And we were able to do a cost seg on the 4-family, even though he's owned it for 4 or 5 years, because there's no limit. There is a limit, but it's one of those that we can go back. We just have to do some extra steps involved. And so if it's a single family, if it's a multifamily, if it's an apartment, anyone can do a cost seg, because once again, the simplistic term is splitting out that original purchase costs.
So I bought a 4-family in 2014, Phil. That's more than 5 years ago. Can I still do a cost segregation on it?
So the key with anything that is done in the past, you have to do the cost seg based upon the original purchase date. So if you've done renovations or you don't have the support to go back, then it becomes really tough, because the IRS is going to want to know, what did the property look like? What kind of carpet did it have? Things like that. But if you have original, pictures or anything like that, then it allows you to use those as support. So yeah, you could. It's just, do you have the support that we could answer all the questions to be able to do the cost seg?
Real quick, I'd like to pause and point out that we have the Q&A feature in this Zoom. If you look towards probably the middle of your screen at the bottom, you'll see a Q&A logo. It looks like 2 comic book text bubbles. If you could use that to ask your questions, that would be great. From Charles, though, Phil, how would you know what you can save on the cost seg without the investigation?
It's tough. You you could get a general idea and come up with a percentage. So let's say, you buy a property for 100,000 and we remove land, which estimates 20%. So you're left with 80,000. Maybe you say, based upon what's in this property, and there's lots of lists out there that you can kind of get a general idea of what a 5-year or 15-year is, or talk with your CPA. But maybe it's 10% of the 80,000. So maybe 80,000 or 8,000 of the 80 is going to be your bonus depreciation. Maybe it's 20%. I would say I've seen anywhere from 30 to 15% falls into a 5 or 15, but it really depends on every property and what that property has within it that you're buying.
How small of an investment property can you cost tag?
As long as it has, other types of assets, so easy examples of a 5-year is going to be appliances, carpet, kitchen cabinets, floating floors. If you want to go small, it could be blinds, certain light fixtures, things like that. Your 15-year is going to be your driveways, the sidewalks, retaining walls, and landscape. And so probably the best way to think about it, and this isn't, once again, consult with your CPA, but if you can use it and remove it, it's probably going to be a 5-year. If it's a land improvement, it's going to be a 15. Anything that is structural or a part of the building components is going to be 27.5. So an estimate, you could probably say anywhere from 10 to 20% on a conservative estimate could get you in that ballpark of understanding.
Is it more advantageous to cost seg older or newer properties?
I think it depends. I think it depends on what your tax situation is in the year that, I think it's easier to cost seg in the year of purchase because there's less paperwork. If you do an older property, you actually have to ask the IRS for permission through a Form 3115. It's an automatic one, but it's one of those that it just really depends because, I was having a conversation with a client earlier today and his income spiked this year. And this could be a great year for cost seg because he's pushing a 35% tax bracket. Last year he was only in a 12%. So it just really depends on where your tax situation is.
Gotcha. I'm responding to one of our questions in the Q&A. Thank you, Preston. We'll get to this soon. I am going to use you guys to actually follow up on Ash's question about older new property, Phil. We're not talking about how recently we bought it. It's about how long the property's been there. So I own the one that we cost seg was built in 1978. I also have one built in 1870. Which one am I more likely to get more value out of cost segregating?
It would truly depend on what's in the building. So I have a client that built a pretty large rental property, brand new, but they didn't keep track of any of the receipts or what was put in. And so they performed a cost seg on that brand new property. And I think they came out with about 25%. So that was kind of on the higher end that I've seen. So it could be, I really can't give an answer on if it's beneficial for like new buildings versus older, because it really truly depends on what's in the building.
A couple of examples, and then Jacob, I'll get to your question. Just for those of you who are attending, this is the part of the webinar where I use your viewership to get my tax guy to give me advice on my properties. So Phil, random example. I bought a 4-family in 24. An investor bought a 4-family in 2014. That investor still has the original inspection report from that. Uh, the property was bought for 170. What's how? I'm not asking you for a number. Tell me how much I'll save. But does it make sense to why would it make sense to or not to cost segregate it?
So the first question I would ask in a situation like that, and I think it might answer Jacob's question, or at least start going down that path, is what's your intentions with that property? If
Our
the
hypothetical investor plans to own it for the long term.
So then I would say the how I look at the tax law and how I view my clients is, especially all clients, but investors particularly, is I'd rather get you the money today because I don't know what tax laws are going to be like tomorrow. And so if I can get you the tax savings today, then we should always consider cost segging anything that you own, especially if you're going to hold it for the long run. And so the reason we could cost seg it, if we have enough support, now all of a sudden we get to speed up that depreciation. And if you've owned something for 5 years, we get to take quite a bit. We can't necessarily do a bonus depreciation on older stuff because we've missed that because you have to do bonus depreciation in the year of the tax return. But we could speed up and use quite a bit of this investor's property from 5 years ago. So in a situation where this person has lots of capital gains and we're looking to offset, this could be a perfect year to go ahead and go back and get a couple of these properties cost segged.
We have some questions pouring in. We will get to all of your questions. Thank you for asking them. They'll sit in Q&A until we get to them. It's my time now. I'm the host. I get to ask no, this is staying on topic. Our hypothetical investor bought a duplex in 2018 for $40,000. This hypothetical investor, who happens to also be named Slocomb, believes that this duplex is now worth around 200,000 and has the comps and the rental income to justify. It's in a nice and improving area. It sounds like my cost segregation would only be based on the $40,000 I paid for it, though. Is there much point in doing that?
So in a situation like that, I would more recommend to go through the amount spent to fix it up, because we might be able to benefit from that quicker than necessarily the 40,000 cost seg. So, because the time it takes or the cost you're going to pay to get the cost seg done on 40,000 is not going to be as beneficial versus going through, if you have a good relationship with the contractor, they can write down, what they put in with the costs, and now all of a sudden with them breaking it out, we can do the cost seg. Even though it's not an official cost seg, it's just really breaking out new purchases or new renovations during that time.
We have a handful of questions that are about a similar topic. What I have, use me as an example, Phil, not just for my own edification, but so that we have something a little more tangible to answer all of these questions. Cost seg, the 24 unit that I bought last year, depreciated everything we possibly could in 2019. So as much of the depreciating that can happen has happened. What's going to happen to me when I sell it for a profit? And if I decide to 1031, how does all of this depreciation through cost segregation affect the 1031?
Yeah, so with us taking the depreciation right up front, it's going to mean you're going to have a larger capital gain. It also could mean that you're going to have some depreciation recapture. And so that's usually one of the first questions when we start talking about cost seg is what's your intentions? Because if the goal is to hold it for a year or two and sell it, it might not be worth the extra tax down the road, but it could still be beneficial to do it. A 1031 is going to roll up all of your accumulated depreciation and come up with it's going to take the basis remaining. It's going to be applied to the new purchase, And so you're starting off with a lower basis in this new property. And so with doing the cost seg up front and doing a 1031, you've really reduced quite a bit of your ability to take a lot more depreciation with the newer property. So it's advantageous if the goal is to hold it, let's say 4 to 5 years, because you can get the tax benefit now. And even if you 1031 or sell it, you'll reap the reward and been able to reinvest all that tax savings from there. So there are negatives. I wouldn't say the negatives, unless you're doing it in a year or two, the negatives don't necessarily outweigh the positives of a cost seg when you do it in that year, in the first year.
Gotcha. I imagine that the people who signed up to listen to us having this conversation are diligent, thoughtful people who are taking notes right now and inwardly digesting the vast majority of what you're saying. But for people who still thinks this sounds like they still think this sounds like demon wizardry, and this should all is a shame and should be illegal, and how could this possibly happen? No taxes. My understanding, and I think Tom Wheelwright says this in the book Tax-Free Wealth, which I believe Phil and I both recommend.
Mhm.
He makes it sound like cost segregation is actually what the tax code expects and almost expects you to do. The 27.5 year depreciation is just set up to be like in the meantime while you're lazy and you haven't got your cost seg done. Is that your understanding?
Yeah, and the reason the IRS is willing to do or allows the whole cost seg is in their mind, they're going to get their tax at some point. And that's how they look at it. Now we can keep 1031 and we can look at gifting and we can look at a lot estate and to truly push off that tax. But most likely, most people are going to eventually sell without a 1031. And so because of that, at some point, the government expects you to pay your tax on that. So pretty much it's the government's goodwill to say, hey, why don't you do the cost seg? We'll let you take the tax break now, but you're going to pay for it down the road. Because you mentioned earlier the appreciation. The government also expects real estate to appreciate over time. And so that's where they're betting on, is that they're pretty much the house is going to win in that situation if it's not done right.
Mark Hutton, thank you for your questions, the ones that we've answered thus far. Can another question from Mark, can a cost segregation be done? Can a cost segregation apply to a tax year different from the year that it's done? I think the answer is yes, because I used a cost segregation, the cost segregation report that was actually done by the previous owner of my property multiple years before I bought it from him. And Phil was able to take that cost seg and reapply it to me. Phil, can you give a more detailed and correct sounding answer than that?
Yeah. Mentioning that you do it in 2021 and apply it to 2020, is that if he's meeting to a property that is purchased in 2021 and apply it to 2020, then no, but really the cost seg can be done up till your tax return. And that tax return could be, if you extend it, could be out till October 15th. So no, the cost seg does not have to be performed in the year of purchase. It just has to be based upon what you purchased that day. So for example, I mentioned earlier, I have a client that built their own rental, and we wanted to apply it for their 2019 tax return. And they didn't get the cost seg done until I think it was August of 2020. So 4 months after the original due date. So yeah, so the cost seg can be done at any point. And the reason we were able to use Slocomb's is there wasn't a ton of changes from when that cost seg was done. So it was still a relevant document. versus, if one was done 30, 40 years ago, that would be completely different. It could be a completely different situation. So a cost tag does not have to be done in the year of purchase. It just makes it easier if you do it shortly after it's purchased. So that way, if you do any renovations or anything like that, you have the proper documentation.
Awesome. We've been getting questions from house hackers. First, let me say, and I think I speak for Phil as well, we love house hacking as an investment strategy. He and I have both lived in multiple house hacks. I thought it was just the most amazing thing when I bought my second house hack that I didn't have to sell the first one to do it, that I was able to keep it and the other property that I owned. Tell us, Phil, about the tax advantages of house hacking.
So the big thing I would say is since 2018, standard deduction itemized has changed. And the reason I start off there is it's a very easy item to show why it's an advantage. So when the standard deduction went up to 12,000 versus the prior 6,000 for single, and then it went up to 24,000 and the prior was 12,000, and there was a lot of restrictions on taxes. A lot of people weren't able to itemize, which means their home mortgage wasn't deductible, which means their real estate taxes weren't deductible. In a house hack, now all of a sudden, the portion that is related to the rental, you get to deduct. And a house hack could be anywhere from, like Slocomb mentioned, his triplex or the 4-family. And like me, I did a single family and I've done a duplex. So now all of a sudden I get to take some of these items that is a taxpayer might not be able to take now with the new standard deduction laws. And so a portion of those get deducted. The other portion is not necessarily tax related, but it's also cash flow related. And so by house hacking, it's a great way to learn how to become a real estate investor, but it's also a great way to keep an eye on your tenants, and you potentially live there for free or cash flow while you live there. The big thing is really, I guess the big thing overall is the cash flow while living in a property for free.
You can keep an eye on your tenants. Your tenants can also keep an eye on you. They know when you get home and they know when they can ask you about their toilet or their light bulb that they won't change for themselves, or the battery in their smoke detector that they're not willing to get on a ladder and replace. I know personally, especially because I came into property, I'm not a professional property manager. I only manage my own properties. But I came here from property management, and I am just now, 6 years later, learning and enforcing personal boundaries with my tenants, turning off the phone, having all of my phones go through an app that I can close and sign out of on my phone. If it's really an emergency, there are emergency services for that. We have a question from Kendrick that pertains more to property taxes. Looking to buy a house hack, analyzing a lot of properties that he's seeing online. He's having trouble understanding what property tax rate he should use in his analysis. Is there a rule of thumb? Is there a standard property tax rate that can be plugged in? I could start answering this. The answer is no. You really need to look into it individually. Cincinnati has disproportionately high property taxes by comparison, the city to the rest of the metro area, but also our metro statistical area by comparison to most other places has really high taxes. In fact, when I started as a real estate agent, I was an Ohio agent working in a Kentucky brokerage, and all the loan officers I talked to complained about how high taxes were in Ohio because a borrower can't afford as much house in Ohio as they can in Kentucky because of the taxes. You really need to look at, go to the county auditor's website, hamiltoncountyauditor.org. as much as people like to complain about Hamilton County, man, the county auditor's website is powerful, and there's some really helpful information on that website. You should have tax as percentage of value, and there should be a number there that you can plug in. The Hamilton County website also has a new calculator so that you can take what your purchase price will be and plug it into the website, and it'll tell you what the semi-annual or annual taxes will be. That said, especially when you get into commercial property, man, you're going to find property tax using the metric property tax as percentage of value. You're going to find everything from the high threes to with a single family, especially an owner occupied single family, and especially if it's in one of the townships like Sycamore Township or Columbia Township, you're going to find significantly lower property tax rates there. So really, there is no rule of thumb. You got to do your research. You got to plug it in. I'll tell you, I have a 26-unit apartment building under contract right now that was at some point sub-parceled into condos. That's a bit of a hassle because it means I'm buying 26 condos instead of one 26-unit building on paper. But on paper, each of those parcels has the residential tax rate. And so my tax rate is like, will be, assuming I buy it, it'll be like 2.6% instead of 3.6%, which is a big deal. 1% of the purchase price. If the purchase price is $1 million, that condo conversion, whenever it happened, is saving me 10 grand a year, assuming I buy this thing. Phil, do you have anything to add to that?
I'll just mention, use the county auditor's site. I think I look at quite a few of the county websites or the auditor's websites, and I do think Hamilton County has a really good one, especially if you're looking for the price. Use that tool, that calculator. It'll calculate your monthly expected expense. So, but no, I think it's tough if you wanted to be conservative on a residential, maybe say 3%, but I think you could find some that are higher too. So
awesome. And thank you guys for the questions. Shameless plug for Phil. When you work with a CPA like him, you get the opportunity, not always, and your CPA will not always answer just because you call, because they are busy. They're good at what they do. They should be busy. You have the opportunity when you work with a CPA to ask these questions on a regular basis. You don't just have to wait for this webinar to come up and pounce on Phil because he's made himself available to you here. That being said, Phil, I got audited a few years ago. You helped walk me through that. Getting audited is scary, especially when you have no idea what the process looks like, and especially when you've heard stories in the media about people who get audited and then end up in jail. All I know is I got a letter from the IRS that told me I had a meeting with one of their assessors, I think it's called, that was scheduled on my behalf, and that I needed to attend that meeting. For the people who are watching and listening, if they get one of those letters, not necessarily why did they get it, but what actually happens next?
Yeah. So the letter is going to, first off, anything from the IRS should be coming from with a letter. And so if you get the letter that says you're under audit, it's going to set you up with a time to meet. If you have a representative, such as a CPA, enrolled agent, or attorney, if you haven't had a power of attorney, you get that signed, which is going to be your Form 2848. And what that does is it allows you to, the person, the attorney or CPA or enrolled agent, to act on your behalf. And so from there, the first meeting or in the original letter, the first thing they're gonna ask for is all your bank records. And pretty much that's gonna look like you need 12 months of bank statements from every bank account, credit card, things like that. And they're just gonna fine tooth comb everything. And what they're looking for initially is going to be consistent deposits or consistent expenses or things that kind of look like it should have been reported on the tax return. And then in the meantime, as they're doing that, they're going to request, hey, can you provide details on this line item from your tax return? Can you provide details on this line item? So for example, it could be you reported 30,000 in auto expense. So they're going to want details on how you came up with that 30,000. If it's mileage or if it's actual expenses, they're going to want to see the detail. Now, detail could be receipts, anything that is coming from a third party that has the date, the name, the amount. Those receipts are by far the best. Then they're also going to ask for your calendar, if you have one, because what they're going to try and do then with mileage versus the calendar is if you can show that you had appointments on this Sunday or that Monday and your mileage lines up to these different places, then it's not just first, it's also second proof that you're telling the truth. So really, they're just trying to make sure that they can follow your proof, your evidence per line item. I've been in a couple audits where they've asked for every line item for receipts, and they'll go through the different receipts and kind of add them up and make sure it lines up. If the receipts kind of line up with what they saw in the bank accounts, then they're usually pretty comfortable. Once they get through the initial review, kind of the expense items, they're going to come back for usually a second line of questions. It might be, let's say, hey, can you help us understand the mileage? Because we see differences going on these different dates. And so now you need to come back and give them updates or more support. And so the one thing that I forgot to mention, the very first meeting is going to be question and answers. And it's really going to be, did you think you did this correctly? Or did you do everything as correctly as you're possible? Or not, best of knowledge? Have you ever done anything illegal? And they just ask all the questions the very first meeting. And the reason I forgot about that is the reason I'm a big proponent of having my clients hire me for an audit is because it adds a level barrier. And so instead of Slocomb going and sitting right in front of the auditor, I sit in front of the auditor. The auditor asks me questions. If I can answer them, great. If I don't know, I say, hey, I gotta go talk to Slocomb, and it gives us time. And so we're not trying to draw it out, but the goal is to, if it's something we need to talk about or get more evidence from Slocomb, now all of a sudden we have this time frame to do that. The other piece with that is the goal is we want to give them what they want, but we also don't want to give them too much in that same conversation. And so an audit can be a couple of weeks, it can be drawn out years. It just depends on the situation and what the auditor is trying to go after. And that's more of an individual. Business can be very similar. They might start looking at meeting minutes because as an S Corp, C Corp, or some LLCs, you're required to keep meeting minutes. And that can be as simple as writing on a piece of paper to an actual official meeting minute notes. And they're going to go through all these different details just to make sure what your tax return lines up to what your evidence and support shows.
That's a lot of information. I hope you guys are able to keep up. If you were not, this is Facebook Live. Get in the Facebook group and you'll be able to play this back. We have some questions from some people in Facebook Live. The first one I'd like to address, since we're talking about being audited and we're talking about cost segs. What happens if your cost segregation gets audited? Do you have to prove the age of each of the appliances from the report? Do you have to prove that everything was in the condition that the report said it was and that you depreciated that way? What is the level of evidence required?
So it's going to depend on every auditor. Some auditors might just say, were you able to break everything out? Some auditors are going to want to see pictures. Some auditors might want to go visit the property. And so the more support you have, the easier it's going to be, because most audits are going to happen not right away. It's going to be a year or two before you get audited. And so the question is, if an audit happens in 2 years and the detailed records weren't kept, how well are you going to be able to support that? So in a cost seg, if you're hiring a third party, which is most likely going to be a CPA firm and an engineer firm, that's a third party support that where their accreditations as an engineer and CPA are on the line. And so they've documented and supported everything. And so that report should be enough. However, that IRS agent or auditor, depending on the day of the week, might want more evidence. And so it's just really going to depend. All I can recommend is the more support or third party you can use, the better.
Awesome. Now, let's say the audit reveals, like in my case, because I was a noob and I was doing my taxes myself, if the audit figures out that you underpaid your taxes for the year for which you're being audited, how are you penalized? What's the result of the audit?
So it depends. And I think before we go there, I read it was a marketing piece by an enrolled agent out from California. I'll have to link it in the notes just so I can quote him properly. But it was in regard, one of the chapters was audit paranoia. And he talked about in 2016, there was 94 million returns filed that year. And of that, the most likely to get audited was a Schedule C or Schedule E with your gross income above 100,000. And it was like 2.8%. If you were a Schedule C or Schedule E with your gross income less than 100,000, it was like 2.3%. And then if you were a LLC or partnership, it was like 1.9. And then if you were an S Corp, it was 1.8. And of that, if you were audited, the likelihood of you leaving with a zero change was like in the 55%. And I can't remember the exact percentages, but give or take, it's right around there. And then if you were audited and you had about a 25% chance of leaving with more money from the table, and the remainder was you owed money. And of the 94 million, only 3,000 returns actually went to court. So I'm not saying don't do things illegally or anything. So please consult with your accountants. But what I'm trying to say is don't fear the IRS from the standpoint of they're not going to come and take all your stuff. If you're responsive and you're doing the best you can, the odds could be in your favor. And so in regards to like in Slocomb's case, the penalties depend. So if they make a change to your tax or to your total tax and it's more than 20%, you still owe, then they add an additional penalty. And I believe that is I apologize. If it's more than 10%, then it's a 20% penalty. So, you could get penalized for way underpaying your taxes. You could also get hit with interest. You could get, I think there's another penalty. So all in all, there's probably about, let's say 20 to 30% of different penalties, depending on how far underpaid you were, plus then the interest.
If you have any more questions about getting audited, feel free to beat the dead horse in the Q&A section. We do have just a couple more quick questions hopefully quick questions from Facebook Live. How does it work if you have a W-2 job and real estate income on the side? Is the goal to be able to write down your total income?
So how I need to read it one more time.
Sure. So the question is a bit vague. The question is if your primary source of income is a W-2 and you're investing in real estate on the side, you're looking to use the tax advantages of real estate to bring your tax burden as low as possible. How do you do that?
So it's going to depend on your income level. So if you're not a real estate professional, then you can potentially fall into the active passive category. The active passive category allows you to take up to 25,000 of losses per year. And so if you're not a real estate professional, then, and I'll get to what those look like. If you're not a real estate professional, then single or married filing jointly from 100,000 to 150,000, you start to get eliminated. So every 2,000 I go up from 100,000 of your taxable income, I lose 1,000 off that 25. So if your W-2, let's say, is 150, well, you can't take any of the losses. If it's 100,000, you can take the full 25, and then anywhere in between, you start to lose that. So yeah, you definitely can reduce your W-2. So what classifies as a real estate professional? That is someone that works in the real estate industry. So in Slocomb's case, a real estate agent. It could be certain construction would qualify as being in the real estate. It could be certain electricians. If you're in that category, then you can potentially start to push towards the real estate professional. And if your W-2 is not in that category, then the next thing to prove is you have to work at minimum 750 hours in the real estate industry, and it has to be more time than your W-2 job. So if you're working 40 hours a week and you can't prove that you've worked more than 40 hours a week in real estate, then you can't qualify as the real estate professional. The active. Oh, go ahead.
Does watching this webinar count as working as a real estate professional?
No, unfortunately, it does not. They also look at financing is more of an investor, not necessarily working in the real estate industry. So it would have to be, if you had 20 some units and you were being active management, collecting rent checks, working with contractors, working with the property management on certain things, anything like that is going to be considered working for it. If it seems more investing, then it's not necessarily towards the real estate professional. But then in the active is you just have to have 250 hours per year. Now, there has been court cases out there that if you just had one rental and you can show that you did majority of the work, then you don't have to hit the 250 hours. It's just, it goes back to, can you prove that you were doing the work? And it's not taking the hammer to the wall or paint or anything like that. It could be working with the contractors. And so just proving that you're putting the time into the rentals. And then the final category is other passive. The easiest way to look at that is going to be syndication, where you have no control. You're just literally an investor. And in that category, you can't take any losses because you're just a true passive investor at that point. So there's three different categories on the ability to take losses. If you can't take a loss in a year, it doesn't mean you lose it. It just means it gets carried forward. And then there's other things in the future that can be used to offset those.
Awesome. Bit of a sidebar question from the Facebook Live that is still pertinent to real estate investing. What cash on cash do you, Phil and Slocomb, see as common in the Cincinnati market today? What do you think about $100 a door? Obviously, it's deal by deal, but wondering what investors are seeing and wanting. I can jump on that first. It depends. My mind goes, especially when you talk about cash flow per door, my mind goes to the non-local investor who has picked Cincinnati out of a hat or off of a list from a blog post in Bigger Pockets because it's a cash flow market. And they're really just looking for cash flow, and they're looking to be as passive as possible, hire a manager, let them deal with it. There are some of them who want dollars per door, and they say things like $100 or $200 a door. I personally prefer the cash on cash return metric. or the cap rate metric. We are seeing properties, larger multifamily, get into the 6 caps that are actually selling, especially if it's newer construction. 7 or 8 cap makes sense for smaller, or that's what we're seeing at least for smaller properties. Cash on cash return, man, if you asked me 5, 6, 7 years ago, 20% was the benchmark. Now 20% is a dream, in part because there are investors from higher value markets. LA and New York are the 2 classic examples, who are coming here for cash flow because they think 12% cash on cash return is phenomenal. And so you're seeing a massive influx of non-local investors into Cincinnati and other markets like Cincinnati because the cash flow is so much juicier here. Um, can That's what investors want. Finding those deals is tough. They exist. Sometimes they exist off market. I submitted an offer on an apartment building listed by a big name commercial broker recently. In fact, he's blowing up my phone today asking me to get him highest and best right now. And that's going to meet it's the first thing I'm seeing in quite a while from a broker that would meet my cash flow expectations. Phil, when it comes to the kind of return or cash flow you're seeing in Cincinnati, what do you have to add to the conversation?
So I would agree with what you said. 5 years ago, 20% would have been, the bottom line. I still, I think there's still ways to get there. I think it's being creative. I think it's, using other people's money. There's many different ways. It's not as easy as it once was. But I would say the newer investor might get, closer to 9-10% just because of just not understanding, which is still for a new investor good. I would say the more experienced is, finding those 15 more consistent. But it just really depends. And once again, the less you're putting in your own cash, potentially that cash on cash goes higher. And the other piece I wanted to add on to what Slocomb was saying about the out-of-state investors. So I think Wall Street Journal released an article the other day, and I was talking with the loan broker about this too. So one reason we're also seeing a lot of out-of-state investors coming in and buying is with how low the interest rates are. These large investors, hedge funds, things like that, can't necessarily put their money anywhere else in a bank or in CDs or certain investments or maybe the stock market's too volatile. And so they would rather have their money sit in an asset. And even if they only earn, 5, 6, 7% on a Cincinnati property, they're happy with it because they know their money's growing. And so that's where we're seeing a huge change from where we were 2, 3, 4, 5 years ago in Cincinnati. We're seeing that bigger push from the out-of-state investors. But I would say, I got a couple clients up in Dayton that have are in the 30s on a few, but they're purely off-market deals. And they're even starting to get more rare types, or rare, not as common ones on those. So.
The question was asked a while ago if Phil used partnerships to scale his business. And I don't know if you guys caught it. He said, yeah, sure, partnerships. And then he explained that he and his partner bought properties that they were able to cash out, refinance multiple times. One of the things that scaled my business, and it sounded to me from what you said, Phil, one of the things that scaled our businesses was buying in an appreciating market. The property that I bought in 2014 appraised in 2019 for twice what I paid for it 4 years ago. Yes, great area. I improved the property. It's performing better than it was then. But we bought during a time of appreciation. We bought at a period in the market cycle. I can't tell you exactly where we were then or where we are now, but we bought at a time in the market cycle where the buying was a lot easier than it is now. And so it may be the case that the best thing to do if you're looking for really juicy cash flow is keep saving money and wait for the market to turn. Or develop a full-time career that teaches you how to find properties off market and analyze them. You close on them, execute a business plan, get them managed and stabilized. If you want to figure out how to do that full time, then that may be the way that you can go now. Slocomb, what kind of IRR do you expect on your property under contract? I don't want to go into too much detail here because I don't own it yet. After I've closed on it, I'd be more than happy to get into a larger conversation about that property. More than happy to. Phil, we had a question a while back I was holding off on. Do you know what's happening with the Cincinnati tax abatements? Are they going away? Are they changing?
So I don't know much about the tax abatements. That's a kind of a different type of tax that I necessarily specialize in. And so yeah, I just don't know a ton about that. The kind of a separate note, and it just dawned on me that I wanted to mention this. So anyone that owns October 30th last year, Cincinnati passed a bunch of new laws. And so if you own any Cincinnati properties, you now need to register. It's not the Hamilton County register. And if you don't register, they're going to fine you $1,500 per property. It's a pretty quick process through their website. And so you have till the 30th, aka Friday, to get registered. So I just wanted to throw that out there as anyone that owns Cincinnati rental property needs to get that registered.
And that's the city of Cincinnati?
Correct. Yeah. So if you're like in Norwood or if you're in North College Hill, those are exempt. But anyone that's in the city of Cincinnati has to. So.
Cool. What about, Phil, one thing that hasn't been asked yet that is more along the lines of tax planning. What do you know about opportunity zones? What do you know about where they are, and what do you know about what makes them advantageous for your taxes? Before you answer, I will say, based on our conversation and other conversations I've had with other investors about opportunity zones, this is really something that you need if you're interested in capitalizing on opportunity zones for real estate investing and tax purposes. You need to be working with an attorney who specializes on opportunity zones and really has an in-depth understanding of how they work and what it is, how it is that you can take advantage of them. That being said, Phil, what do you know about opportunity zones?
So yeah, so an opportunity zone can be, it's a potential big tax savings. High level, if there's two different sides. Are you starting one, or are you just investing in one? The starting one is what Slocomb was saying. Working with the tax attorney is by far the most crucial piece, because there's a lot of documents that have to be properly done, and you have to have a special type of business set up. Usually it's a corporation or a partnership setup, slightly different than just a normal LLC or partnership. So definitely, if you're looking to set one up, definitely work with an attorney. If you're going to invest in one, the biggest misconception that I've heard from clients or just anyone kind of asking is it's the gain that you're selling. So, if you had $100,000 in Procter & Gamble stock and you sold it, it's not necessarily that 100,000 that you're getting the savings on. It's the capital gain piece. So if your basis was 80,000 and you sold it for 100, there's a $20,000 gain. That's what you get the tax savings on. So knowing what your gain is the crucial piece for the opportunity zone. I should have started off. I'm not an expert in the opportunity zone. I've just done a lot of research, just so I can have these general conversations. So then kind of going back to where I was, if you sell the stock or you have the capital gain, the goal is you have 100, I think it's 180 days to reinvest in a qualified opportunity zone. And so they should have the paperwork to prove that they are qualified. And then on your personal tax return, when you report the capital gain, you need to make sure there's a certain box checked that shows that you're joining into an opportunity zone. In regards to the tax savings, so the the biggest thing is you have to keep it in the property at least 5 years, or the opportunity zone, because that's when the tax savings starts. So if you do it 5 years, you get a certain percentage. If you do it 7 years, you get more. 10 years is the best. You get credits for certain taxes in the future. I don't know enough details to go into too much more, but that's the high level. Is you got to keep it in 5 years, and it's potentially the capital gain in the year of sale of the asset is what you get to get the tax savings on.
Cool. We have one more Facebook Live question for you, Phil. Will your company, Strategic Tax Services, and other tax planning CPA firms, do you run projections in the fourth quarter of the year so that investors and your clients can potentially make adjustments to their financial plans for the year before it's too late?
Yeah, so anytime I work with a prospect or a current client, the goal is to work with them in the fourth quarter. So I actually, about a week and a half ago, sent out my year-end tax planning meetings, which what that looks like is you provide your financials, if it's from the business or pay stub or anything like that, and we build a mock draft. And so what that does is it allows us to have the conversation of what's your tax looking like? How do we reduce it? Is there anything you want to do this year to reduce it? Or are you looking to buy a property or sell more stock? And so, yes, to answer the question, yes, definitely. That's what gets me the most excited is the tax planning. And so the fourth quarter is a perfect scenario to do that in.
I don't know how often you all have the opportunity to ask questions from someone who gets excited about tax planning, but I am glad we've had a lot of questions from a lot of people, and you all have taken advantage of this opportunity to be in front of Phil. Changing gears a little bit, I only have one more question for you. Last call for those of you who are on Zoom. If you're just watching on Facebook Live, it's too late. Click the Zoom link and you can ask your question here on Zoom. But for those of you who are in Zoom, this is your last call for questions. My last question for Phil. I know your son is 4 months old now. You guys have probably seen, if you're looking at me while Phil's talking, you see my face is all over the place. I'm checking Facebook Live on my phone. I got ADHD going on all around. I also, however, have this photo of my daughter on my desk that I keep looking at as we're talking. I know for me, the birth of my daughter almost a year and a half ago, I was fortunate that I was digging my well before I was thirsty, but finally actually being a father changed the way that I thought about real estate investing. You and I talked about this a little bit yesterday, Phil, leading up to today. And we both use the word more often now, the word legacy. Tell me what that means to you and how now that you're a father, you're thinking about real estate more in terms of the legacy that you're building.
Yeah, definitely. And so I don't have a picture of Brantley in my office quite yet, but I just got this today, and so he's a happy young boy. But yesterday when Slocomb and I were talking, I think the biggest thing with investing that I think of, or my life, is how do I build a legacy? And so I really honor that word for Brantley. Legacy is one that it can mean lots of different things. And I think one, how does my son look up to me? How does my son, do I value his time? Does he value my time? But I think the next step is how do I build a financial legacy? How do I, build something where if he wants to go to school, or if he doesn't want to go to school, or a way where he can experiment. And that can be, the beauty of real estate is it allows you to try different things. If it's plumbing, electric, and some of that's the dirty stuff. But, as when I started in real estate, I did a lot of the work. And so it allowed me to use my hands. It allowed me to work with my father-in-law. And so I think of the days where he can learn that. And to take it a step farther is I don't want to ever pressure him to go to school. If he wants to do something else, or if he wants to push the investing, I'm not saying he shouldn't have to learn something, but I don't believe he has to go to an official college to learn something where you can learn more in experience. And so by having a legacy business or a bit rentals, or however it ends up being, he has the ability to experiment and learn on his own, or learn with me. And so my goal for when we found out we were pregnant is I just want to make sure I'm there, and I also want to make sure I can be there, not just financially, but be there time for the time that I cherish. And so there's the legacy is wide open. And so my new goal is now to see how hard I can push while being there for him, and then also get him excited for the real estate, but maybe excited for the tax side too.
Yeah, I want to see how you get a child excited about taxes. In summation, I want to take us back to one of the first things that Phil said. Keep in mind, he came into real estate as a tax preparer, and now he's in a position, and so am I, where we're thinking about what we are building for and eventually leaving behind to our children. Phil started off by saying that as a tax preparer, he was working with Fortune 500 companies and very high net worth individuals. And he saw what they were doing, and they got him into rental property investing, buy and hold investing. The tax guy on this webinar is a buy and hold investor because of the tax advantages of buy and hold investing that you don't necessarily get from other forms of real estate investing. That being said, if we don't have any other questions, which it looked like we do have a question. If you use your primary residence for rental, can you sell it to your LLC to use the tax-free gains and then count it as a rental?
So the IRS is big about not related parties. So you really can't sell it to yourself and get the same tax advantages. So pretty much the answer would be no, you can't get the tax-free gains selling it to your LLC. So at that point, it just be contributed to the LLC.
There are a couple of major advantages, though, to owning a property in an LLC as opposed to your own name. If you live there, keep in mind if you have a residential mortgage, whether it's owner-occupied or non-owner occupied, the bank is going to want to see that the property is titled in your name and it stays that way. Yes, there are loopholes. That's not the question I'm trying to answer here. The advantages to using an LLC are not necessarily tax driven. It can help with anonymity if that matters to you, not letting the world know who owns the property. But more importantly, when it comes to liability, if you own 5 rental properties in your own name, or let's say I, Slocomb, own 5 rental properties in my own name, and someone's going to sue me because of something that happened at one of them, because I own 5 rental properties, their lawsuit can involve all 5. If properties 1, 2, 3, 4, and 5 are owned by property 1 LLC, 2 LLC, 3 LLC, etc., then if there's any sort of legal action against me involving one of those properties, they can only go after what that LLC owns, so long as I have it structured correctly. Not going to go into all of the ways that you make sure an LLC is structured correctly. That's not today's discussion, but that's definitely something that you can Google or YouTube or find on Bigger Pockets.
The one thing I'll add to that is I've noticed a lot of the first thing to save money is not to hire an attorney and just file the LLC on by yourself. If the goal is really to be anonymous, then if you file for the LLC in the state of Ohio by yourself, your name's still out there. Let me use an example. So the house across from my personal house has been being renovated for 2 years now. And I was just kind of curious to see who owned it or what was going on, and found the LLC per the county website, looked it up on the state website, the LLC, and it went back to an attorney's office. Perfect. That's what it's supposed to do. Keep your name out. Unfortunately, the individual posted on Facebook the name of the business and started publicizing about it. So now all of a sudden I knew who it was, found out he owns 7 or 8 pretty large businesses in the city of Cincinnati. And so the goal is, if you really want to be anonymous, hire someone to do your legal documents with the state, because that way your name's not associated with it. The LLC is also going to protect it on the county website. And then just be smart about what social media, because once you start posting, it can start to get away pretty quick.
Absolutely. Awesome. 8:28, we kept it under an hour and a half this time. Thank you all for attending. Phil, what is the best way for someone to reach out to you if they have further questions?
Yeah, so the best way, and I'll put it on the Facebook group, but my email, it's going to be phil@mystslllc.com. And then the phone number I'll also put out there, which is 513-480-6909.
Excellent. If you guys didn't catch that, he will post it here soon. You can post it as a comment on the Facebook Live video as well. If you want to get a hold of me, DM me on Facebook, or comment on this video in the Facebook group. If you're not in the Facebook group yet, you've seen this random video off guy named Cody. One of the things he does is make sure that you get invited. You got here because you registered, so they have your email address to invite you to the Facebook group. That being said, thank you for coming to our October 2020 edition of the Cincinnati's Best Ever Real Estate Investor Mastermind webinar. The last Tuesday in November is, pause for effect, also because I'm loading my calendar, the 24th. So Tuesday, November 24th at 7 p.m., we will have the November edition of this meetup. Haven't found out who I'm interviewing yet. May ask someone else to interview me. We'll see how it goes. Regardless, appreciate you guys being here, and see you next time. Thanks again.
Thanks, guys.